Year after year, the stock market has reached new all-time highs. You have some cash ready to invest, but it feels like the worst possible time to buy. And I'm here to tell you this is what happens if you only invested at all-time highs. Leaflet Financial Advisors look at 98 years of S&P 500 data and ask one simple question. What happens if you only invest at all-time highs versus waiting for a 10% correction first? The answer might surprise you. Investing at the top gives you a 1-year annualized return of 13.7% compared to just 11.7% if you wait for the correction. Stretch that to 3 years and you are still ahead. 10.6 versus 10.3. Go up to 5 years and it is 10.3 versus 9.6. Now I know what you are thinking. That makes no sense. How is buying at the top better than buying at a 10% discount? In this video, I'm going to show you 5 charts why buying at all-time highs beats buying at any other day. At the end of this video, I will review my tip how I remove my fear investing at all-time highs. No, it is not dollar cost averaging. I guarantee you, nobody has talked about this before. Before we get into the charts, a quick word from today's sponsor, Longbridge. If you have either cash sitting on the sidelines, Longbridge is running a limited time promotion. Cash Plus is the feature you opt into. Once you do, your either cash get automatically invested into the iFast SGT Enhanced Liquidity Fund, which spreads your money across high-quality bonds and fixed deposits. Over the past year, it has generated a return higher than a regular savings account. Longbridge is running a promotion that ends this month. If you opt into Cash Plus, you will get a 5% interest rate boost on your first $4,000 for a full year. That is $200 in bonus interest over the year. This boost used to be capped at your first $2,000. Now they have doubled it to $4,000, but only until the end of this month. On top of that, when you are ready to start investing, deposit $2,000, hold it for 30 days, and make 3 buy trades. You will get up to $80 of Nvidia shares. If you qualify a higher tier, you can get up to $1,270 of Nvidia shares. These promotions are exclusive to my channel and are ending this month. Scan the QR code on the screen or hit the link in the description. I may earn a small commission at no extra cost to you. Thank you so much for supporting my channel. Let's look at the 5 charts together. Why buying at the top is better than buying at a 10% discount. Take a look at this chart from a wealth of common sense. It is the S&P 500 going all the way back to 1950s. The blue line is the price and every single grey dot is a new all-time highs. Look at how many all-time highs are on the chart. Too many to count. First thing to understand, all-time highs are way more common than you think. All-time highs are not rare. They are not special. They are not signs that the market is about to crash. Look at this second chart. It shows how many new all-time highs the S&P 500 hits every year since 1990s. See those tall blue bars? 1995 had 77 new all-time highs. 2021 had 70s. 2024 had 57. These are not one-off events. They come in waves. Since 1990s, the S&P 500 has hit new all-time highs an average of 20 times a year. When the market hits an all-time highs, it doesn't usually crash. It usually hits another all-time high and another and another. And now look at the flat stretches near zero. 2001 to 2006, 2008 to 2012, same thing. The painful years where the market just couldn't catch a break. So if you are waiting for a crash to buy, you might be waiting for a very long time. Don't just take my word for it. Vanguard ran the numbers. Each chart asks the same question. If you bought at an all-time high, how likely is it that the market will be even higher later? 1 year later, 74% of the time, the market was higher. Only 26% of the time, the market was lower. 5 years later, 84% higher. 10 years later, 93% higher. And 15 years later, look at the last chart. It is basically a solid ring. 100% of the time, the market was higher than the previous all-time highs. So if you are investing for the long term, the all-time highs that you are scared of today is almost certainly going to look cheap 15 years from now. This is the one that really gets me. Look at this 4th chart. Blue bars are returns from investing at all-time highs. Grey bars are returns from investing on any other day. 1 year forward return, investing at an all-time high gives you 9.4%. Investing on any other day gives you 9.1%. 3 years forward return, all-time highs wins again. 29.1% versus 27.3%. 5-year forward return, 50.2% versus 48.5%. Every single time period, the blue bar is taller. Let me say that again. Buying at the scariest possible moment when the market is at record highs has historically given you better returns than buying on any other day. If you struggle to deploy your money at all-time highs, save this video. You will need it every time the market hits new all-time highs, whether you are watching it today or 10 years from now. Here is the most important chart I want you to remember. Look at this pie chart on the left. It tracks the 50 best best trading days in the S&P 500 from 1996 to 2025. 48% of those best days happened during a bear market. Another 28% happened in the first 2 months of the bull market recovery. Add those together and 76% of the best days in the market history happened when everything felt worse. Now look at this second chart on the right. It tracks what happened to $10,000 invested in the S&P 500 from 1996 to 2025. Stay fully invested the whole time, your money grows to 192k. If you miss the 10 best days, you are down to 85k. That is 56% less. If you miss the 20 best days, you are down to 49k, down 74%. If you miss the 30 best days, just 31k, down a brutal 84%. By the way, if you want more evidence-based investing content like this, hit the subscribe button now so that you don't miss any of my next videos. Okay, so we have seen the charts. We now know that buying at all-time highs has historically worked out better than buying on any other days. But why is buying at all-time highs so difficult? Here are 2 reasons why. The first reason is something called loss aversion. Losing $1,000 feels about twice as painful as gaining $1,000 feels good. So when the market hits records high, your brain isn't thinking about the gain you might make. It is screaming about the loss you are about to take. The second reason is that you are falling for the gambler fallacy. This is a belief that because something good has happened for a while, something bad must about to come soon. But the market doesn't work like this. The market has no memory. It doesn't know it just hit a new record. Now you know the reason why. You are now asking, how do I conquer the fear of investing at all-time highs? Most Singaporeans set up a regular savings plan. If you are using Longbridge, they have this built right in. Just go to your app, tap portfolio, then more. Then recurring investment. Here you can pick your ETF, frequency and amount. It automatically invests for you, whether the market is at an all-time high or not. But if that still doesn't help you, I have one last tip you won't find in any other investing videos. Here is something I want you to try. Open up the ETF that you invest in. I will use the S&P 500 in this example. Zoom out to the maximum time period, the full history, and I guarantee you the ETF is going to look so expensive. There is barely any space left at the top right of your screen. It looks like a big crash is due to happen. But now this is my secret. Draw a channel over the chart as best as you can fit. Then I move the chart to the left and then down. Now this is where the magic happens. I move the channel so that it starts from today's price. Look at how much runway your money can still climb even if you buy at all-time high today. Whether you buy at today's peak at 7,500 or wait for a 10% correction at 6,700, it won't matter much down the road. The S&P 500 could still grow to more than $11,000 to $15,000 in 30 years. Tell me in the comments what you think about this tip. But remember, past performance is not future returns. So make sure you understand your personal risk tolerance before you invest. If you have watched this video so far, I think you will also be interested in my video, Dollar Cost Averaging versus Buying the Dip, where I show you a study where 5 investors deploy their money using 5 different strategies. The results will surprise you. Click here to watch it.